In today's video, I'm going to talk about why real estate is an outperforming investment, and I'm going to compare it to the S&P 500, which has been one of the greatest investments over the last 45 years. And I'm going to compare and contrast why real estate, I think at least, is going to outperform even moving forward into the future. Now, if you're new to my channel, my name is Koukun, and I'm a real estate investor, and I run a real estate team here in the Niagara region. If you're interested in knowing more about what we do, check out the link in the description below of our beginner's guide to investing in the Niagara region. Now, to start with, over the past 45 years, the S&P 500 index has compounded at close to 12% per year over that long period of time. So that's an incredible result, which is actually, frankly, the exception. When you look at longer periods of time and multiple countries, very few countries have come anywhere close to creating that much of a compounded rate of return. And most of the experts believe that moving forward into the future, that's likely not going to be the case. In the same time period, using the Toronto Real Estate Board's average sale price data, we know that the average sale price of a home in Toronto has increased close to 6.6% over that same 45-year time period. And keep in mind, back in 1976, when this data started, the average sale was more likely to be a freehold property like a semi-detached or a detached home. And now we've moved closer to condos, either in high-rises or condo townhouses. So this compounded rate of return may actually be less than the actual return that an average investor would have received by simply owning a freehold property over this last 45 years. That being said, even when it comes to real estate investing, this is kind of the exception when it comes to the results in terms of a compounded growth rate. It is not the same everywhere, so each region is different. So let's start with the first reason why I think real estate is going to be an outperforming investment. Reason number one is outpacing inflation. When you own stocks, you have to deduct the rate of inflation from the growth rate that you receive from owning that investment. So for example, over the past 45 years that the S&P 500 has grown at 12% a year, during that same time period, the average rate of inflation was also 4% a year. So the true real return that the investor received is closer to 8%, not 12%. Now, the reason why real estate outperforms inflation is typically when you buy a rental property, you put 20% down and you borrow 80% of the purchase price in the form of a mortgage. Now, the interest on that mortgage should be covered by the tenant paying rent, and hopefully you buy a property that has cash flow, so there's a bit of extra money to cover any incidentals as well. But because the interest is covered by the rent that you receive, the value of the money you borrow over time reduces in value as inflation takes its toll. So the reality is, if you have, for example, 4% of inflation, the 80% of your purchase price that you've borrowed is also losing value. So your equity will grow faster than the pace of inflation when it comes to a leveraged real estate investment. And as a result, real estate is one of the few investments that will actually outperform when there's a moderate rate of inflation, when most other investments like stocks and bonds tend to do poorly when inflation is moderately high. Number two is reverse compounding. Most of us are familiar with the concept of compound interest, where if you double an investment multiple times, it grows exponentially into this crazy large amount of money. With real estate, there's something slightly different. Because you borrow 80% of your purchase price upfront, for example, if a home's price goes up 5%, your investment actually goes up 25%. There's a 5 times magnification of the rate of return because you've leveraged 80% of your purchase price. This goes a long way when you're starting out to take a small amount of money to grow it to a sizable amount. And this does drop off once you start hitting, a certain net worth. And for example, if you have 50% equity in your properties, then the rate of return does decline because you have more equity in the deal. And that's fine, because practically, if you think about it, the whole goal is to get to a certain net worth where you have enough money to pay for retirement and sort of to live the life you want to live. And it's okay that the rate of return does go down as you accumulate a certain net worth. Contrast this to investing in the stock market. When you buy a stock, you own a stock. When you buy an index fund, you own one index fund. The real compounding in the stock market happens over very long periods of time when the companies that you invest in, create earnings, reinvest those earnings, and sort of grow their businesses. And that typically takes a very long time before you see the fruits of the compounding, typically at the end of the investment cycle. So by this process of reverse compounding, you get your returns up front in larger percentages, and you can then refinance your properties, take the equity out, roll it into a second or a third property. And this is one of the ways I've seen quite a few investors build a lot of wealth very quickly in shorter periods of time, because they're able to get the return up front, not at the end of 30 or 40 years. Number 3 is fee-driven behavior. One of the unique things about real estate is when it comes to purchasing a property, there's typically very little cost that you have to pay out of pocket. The real estate commission that an agent makes is typically paid by the seller. Now, as an investor, once you buy the property, if you decide to sell, you typically have to pay anywhere close to 5% of your sale price of that home. So that's a significant chunk, but it's deferred to when you sell the property. What ends up happening with real estate investing, though, is that this becomes a very powerful tool to drive good behavior. You are less likely to sell the property because you have to pay a large amount in commissions. So you hold on to it for a longer period of time, usually, which allows you to get the market return. You get the full return of owning real estate over longer periods of time. Contrast that to the stock market. Because it's so easy to buy and sell stocks, buy and sell index funds, what ends up happening is that people typically sell the investment at the worst time. Every time there's a panic or a scare of some kind, many investors tend to sell their investments and get out of the market at the worst time. And when prices are at all-time highs, they tend to buy at the worst time as well, because there's so much hype, there's so much euphoria. With real estate investing, while there is definitely that hype on the buying side, because definitely when the market goes up, we see it quite often where more investors are interested in investing, because of the fee-driven behavior that's caused by owning real estate, it tends to cause investors to hold on to the assets long enough for them to see a profit, because usually no one wants to pay that fee out of their own pocket, out of their own investment. They want it to come from the profits they make from the investment, which usually results in them waiting to get profits from their real estate, which is actually a very good thing. The other aspect of fee-driven behavior is that when it comes to real estate investing, there's only typically one fee you pay, which is the commissions when it comes to selling the property at the end of the ownership of that rental property. So basically, you pay nothing to buy it and you pay nothing to own it over the 10, 20, 30 years you may own your real estate investment. You may pay property management fees, you may pay maintenance and repairs, and hopefully your property has enough cash flow to cover that, but you're not really paying a fee on your assets, on your equity. When you contrast that to owning investments in the stock market, now if you're very smart about it, you buy index funds where the fee is very low and you pay a few percentage points, like 0.025% of your investment, for example, to Vanguard for their index funds. But most of the people that have been investing in the stock market over the last few decades, typically it's been done through mutual funds or working through investment advisors who take 1 or 2% of their portfolio on an annual basis. If you imagine, with real estate, you don't pay anything annually to hold this investment. You just own it, and you may pay for services here and there, but no one's charging you a percentage of the assets that you own. So over time, that percentage of asset fee, if you look especially in mutual funds, you may end up paying half to 2/3 of your potential return to fees to the advisors who are helping you buy that investment and own that investment. Versus with real estate, you only really pay the fee once when you choose to sell, and if you never sell that property, you actually never pay a fee. So it's quite an interesting scenario, because a lot of people talk about real estate commissions as being very large, and it is a significant cost, but from an investment perspective, it actually drives good behavior, which is a strange concept to wrap your mind around. So I hope you found that helpful. Real estate investing has been a part of my journey for the last 8 years, and I'm planning on owning real estate probably for the rest of my life. But at the same time, I do see the value in investing in index funds that invest into the stock market. So that's also going to be a component of the investments that I have for diversification, and to have some assets outside of real estate, which, over time, as you build up equity in rental properties, it does make sense to take some of it outside and invest it separately. So that's what I'm planning on doing. I hope you found this helpful. If you're interested in getting started in investing in real estate, definitely check out our beginner's guide to investing in the Niagara region. I'll have it in the comments below. And if you have any questions, feel free to let us know. All the best.